When is the last time that you looked at the financial sector of equities? Apparently, it's been a while for a lot of people, considering some recent survey results that I got back. Let's have a look, because I think the financial sector may be giving us a bit of a clue that we could encounter finally a pause in the broader market. Let's have a look at it. I'm looking at the XLF. This is the ETF that tracks the S&P 500 financial sector. And we're just going to look at the price action here. This is a long-term weekly chart. This goes all the way back to 1999. But you can see if we draw a very simple blue line, we have a really clear level around $30 where that has in the past acted as resistance. And they finally broke back above that in 2021 after, of course, the great financial crisis crashed the sector. Then we retested as support in 22, and we're going back up since. Now, what's really interesting here, and I'll go into the daily chart in a second, is that we've now basically retested just a couple days ago the previous all-time highs from January 2022. The recent rally here is basically the same one that we've seen in the broader market. We've seen the financial sector essentially beeline without any pause, 32% from support, that big blue line, right back to the previous all-time highs. Now, this does not mean that the financials are going to fall apart here, but typically speaking, when you reach that kind of a point, there is some backing and filling. So if we now go into the daily charts, what you can see is what I'm using here is essentially the 21 and 8 period moving average, because that has been what the algorithms have been focusing on very closely. We got quite extended above it. We're now breaking back towards that moving average. I think ultimately we might break below there, and that'll kind of confirm more of a consolidation phase. But again, I want to look at this through the lens of where we are in the bigger picture. I think it's more likely than not, in fact, a lot more likely than not, that we see some consolidation here rather than a big break higher. And I think if the financials do that, the broader market, we've already seen momentum stocks show us a little bit of weakness, nothing to write home about, but the MAC 7 stocks are basically now the MAC 2 or 3. So we're certainly seeing, a slowing down. At the same time, a momentum, at the same time we're seeing a broadening of the rally, but it's been in check. We've seen broadening, but it's not been blowing anyone out of the water in terms of new momentum. My best idea to take advantage of these kind of situations is to use options credit spreads, because it allows us to put on trades with, in my view, with better risk management than putting on directional trades. So for example, one idea I'm floating about right now is to maybe do a bear call spread on the financials, on the XLF, or maybe even on JP Morgan, because that's such a big part of it. And the only bet with that would be that it doesn't go up here. So I would basically be making money whether this ETF were to go down a little bit or go sideways, or even if it were to go a little bit against me. Whereas at this point, if I were to buy a put, the only way I could make money is if it goes down. Now, there are times in the market when it makes more sense to use options credit spreads than directional trades, and vice versa. I think right now, given where we are, there's a lot of opportunity to use options credit spreads, and they allow us to generate income too, which is a really nice thing. So if you're interested at all in using options credit spreads in kind of a unique way, kind of like almost the opposite way in which a lot of people do it, I'd love to see you in this week's discussion. You can sign up for that down below or on the next screen. And of course, bring you questions, because I'm sure there's a lot of questions on this kind of strategy. So we'll see you there.